The 2026 global economy is sending 5 clear signals, and most people are not reading them correctly. Today, we break down 5 verified, institutionally sourced economic facts. Data from the Federal Reserve, the IMF, the Bureau of Labor Statistics, Goldman Sachs, and JPMorgan that explain exactly where we are and why it matters for your financial future. No speculation, no clickbait, just the data. Let us get into it.
Chapter 1. Quantitative tightening is over. In December 2025, the Federal Reserve officially ended its balance sheet reduction program, a process that had been running since mid-2022. At its peak in April 2022, the Fed's total assets reached $8.97 trillion. As of April 30th, 2026, that figure stands at $6.75 trillion, a reduction of $2.21 trillion. Now, here is what is critical to understand. The end of QT does not mean the Fed is easing. It means the Fed has stopped tightening. There is a significant difference. The federal funds rate remains at 3.50 to 3.75%, as confirmed at the April 29th FOMC meeting. The Fed will not cut until inflation returns to its 2% mandate, and we are not there yet. The key word for 2026 monetary policy? Maintenance.
Chapter 2. Inflation. The number everyone watches, and the one the Fed cares most about. March 2026 Consumer Price Index, 3.4% year over year. That is the Bureau of Labor Statistics figure, published April 10th. Core PCE, the Fed's own preferred measure, came in at 3.2%. Bureau of Economic Analysis, April 30th. The Fed's mandate is 2%. We are sitting at 3.4 on CPI and 3.2 on core PCE. That is a gap of 1.4 and 1.2 percentage points respectively. On the recession side of the equation, Goldman Sachs assigns a 30% probability to a U.S. recession in 2026. JPMorgan is slightly more pessimistic at 35%. Bloomberg's consensus survey puts it at 28%. The modal outcome, meaning the most likely single scenario, remains a soft landing, but the distribution of outcomes is wide. Services inflation, elevated shelter costs, and potential tariff pass-through effects keep the Fed's hands tied. Rate cuts require patience, and patience requires data.
Chapter 3. De-dollarization. This is perhaps the most misunderstood trend in global finance right now. Let us start with the IMF data. The currency composition of official foreign exchange reserves report, published March 27, 2026, shows the US dollar share of global FX reserves at 56.77% in Q4 2025. In the year 2000, that figure was 71%. Over 25 years, the dollar has lost 14.2 percentage points of reserve share. On the payment side, SWIFT's RMB tracker from March 2026 shows the dollar at 51.1% of global payment transactions. The yuan sits at 3.1%. Still small, but growing. And the gold picture? According to the World Gold Council's Gold Demand Trends report published January 29th, central banks net purchased 863 tons of gold in 2025, with an additional 31 tons in January and February 2026. Here is the key insight. Central banks are not abandoning the dollar. They are reducing concentration risk. That is rational portfolio management at a sovereign level. And it has been happening for 25 years. The direction is not a surprise. The pace is.
Chapter 4. The AI capital expenditure supercycle. And when I say supercycle, I mean it literally. Based on Q1 2026 earnings calls, the actual forward guidance issued by corporate management teams, here is what the 4 largest technology companies are planning to spend on AI infrastructure in 2026. Microsoft, approximately $190 billion. Amazon, approximately $200 billion. Alphabet, approximately $180 billion. Meta, between $125 and $145 billion. Add those up. you get an estimated $695 to $735 billion in a single calendar year on artificial intelligence infrastructure alone. To put that in perspective, that is larger than the GDP of most countries. And this is capital expenditure, meaning physical data centers, semiconductor chips, power infrastructure, and cooling systems. The downstream beneficiaries are clear. Semiconductor manufacturers, hyperscale data center operators, power utilities, and the companies building the physical infrastructure of the AI age. This is not speculative. This is guided by the companies writing the checks.
Chapter 5. The K-shaped economy. And this is the fact that I think has the most real-world impact on the people watching this video. Bank of America Institute published a wage growth gap report on April 9th, 2026. Here is what it found. High-income workers saw wage growth of 5.6% year-over-year in March 2026. Low-income workers saw 2.0%. That is a 3.6 percentage point gap in the same labor market at the same point in time. On the wealth side, New York Federal Reserve Liberty Street economics data, published May 1st, 2026, shows the top 1% experienced net worth growth exceeding 25% since 2023. The middle 40% of the wealth distribution, under 10%. What this tells us is that the macroeconomic statistics, GDP growth, unemployment rate, aggregate consumption, are masking a profound divergence in lived economic reality. The K-shape is not just a chart pattern. It is two fundamentally different economies operating simultaneously within the same national borders. Asset inflation benefits those who hold assets. Wage growth benefits those whose labor is scarce. The gap between those two groups has not closed. It has widened. Every single quarter. Chapter 6. The Verified Summary. 5 facts. Every source named. Let me run through them quickly. 1. QT ended December 2025. Fed balance sheet at $6.75 trillion. Funds rate at 3.50 to 3.75. Maintenance mode, not easing. Federal Reserve H.4.1. 2. CPI 3.4%. Core PCE 3.2%. Fed target 2%. Gap persists. Recession risk 28 to 35% per Goldman, JPMorgan, and Bloomberg. Bureau of Labor Statistics and BEA, April 2026. 3. Dollar FX reserve share fell to 56.77%, down from 71 in year 2000. Central banks bought 863 tons of gold in 2025. IMF and World Gold Council. 4. AI Capex estimated $695 to $735 billion in 2026. 4 company earnings calls. Bloomberg. 5. Wage gap, 3.6 points. Wealth gap, top 1% over 25% versus middle 40 under 10%. Bank of America and New York Fed. Measured close. Every single one of these numbers is independently verifiable using the sources listed on screen. If something changes, if the data updates, we will update the analysis. That is the macro pulse standard. That is the 2026 global economy in 5 verified facts. If this video gave you one clearer picture of what is actually happening, one data point that cuts through the noise, then we did our job. Subscribe to Macro Pulse Business for new economic intelligence reports every week. Like this video if it added value, and share it with someone in your network who needs signal over speculation. We are building the most credible, verified economics channel on YouTube, and we are just getting started. Business and economy intelligence. Simplified. See you next week.